With the risk-on trade accelerating, I see some the best outperformance opportunities coming from some of the really the worst performing markets so far on a year-to-date basis. I'll give you an example. The emerging markets have performed horribly this year. They're only up about 5–6% over the past year, compared with a 24% gain in the S&P 500, the largest U.S. stocks. But over the last couple of months, that trend is really reversed, and emerging markets are now beginning to outperform the more developed markets, not just the U.S., but Europe, Japan, some of the other markets. Now, it's on a case-by-case basis. You have to be very selective. It's not every country across the board. You know, you can't just go out there and buy all the bricks anymore like you used to be able to get away with maybe 10 years ago. Now, you have to be more selective. You have to look for the countries that are really generating good domestic economic growth rather than relying on exports. But there's a lot of opportunities that I think will increasingly be more along the lines of international markets. I think what makes emerging markets and especially some of the global cyclical sectors most attractive right now is performance, or perhaps lack thereof. The emerging markets, as we said, have underperformed the U.S. for actually not just so far this year, but for the last 2–2.5 years they've underperformed. And a lot of the domestic cyclical U.S. stocks that are most exposed to overseas sales, that get a lot of their revenue, a lot of their profits from these international markets, you know, they haven't fared all that well either. They've, you know, kind of dragged a little bit. It's been mostly consumer stocks, you know, last year in 2012 and even in the early part of 2013 that performed the best. But we've seen a real reversal of fortune in that particular trend. As a matter of fact, since the end of June, a lot of the more internationally exposed sectors, like information technology, for example, have outperformed a lot of the other sectors in the market. IT is up 14% since the end of June, whereas the broad market's only up about 10 or 12%. And, you know, for information technology, in general, all the companies in that group get about 40% of their total sales from outside the U.S., so they're very foreign exposed, and I think that's a theme that's going to pay off handsomely over the next several months. Yeah, it goes without saying that emerging markets and even cyclical stocks do carry some additional risks. They are higher beta, you know, higher risk trades. That is, they're more volatile, you know, than your average stock. Certainly information technology stocks, for example, are more volatile than, let's say, healthcare or consumer staples like Coca-Cola. But that said, I think the best upside potential over the next 3 to 6 months could come from the more cyclical sectors, that being technology, also energy, industrials, and especially basic materials. So instead of, you know, purchasing some of these international ETFs that maybe carry the most risk, an ETF that focuses only on China or only on India or Brazil, for example, I think some of the best opportunities are in U.S. homegrown companies that get a lot of their sales and their profits from overseas in those cyclical sectors. For Money and Markets, this is Mike Bernick. Good investing.